Welcome out to Trading Justice Podcast, The Aftermath. Very dramatic. Had a lot of drama, though, in the markets. A lot, some separation, some really strong moves, some counter moves. One of my favorite movies as a kid was that movie that was put, I think, on NBC, Matt, where there was the nuclear apocalypse. I can't remember the name of it, but they were dealing with, the aftermath of that. As a child of the 80s, we hid under desk and stuff. But we're going to break down all of the drama.
Did you say Matthew Broderick?
I did not say no. No.
Are you talking about that the one where he's riding the nuke on the way down? The dad has.
No, that's before. That's before me. Listen.
There was a few nuclear Holocaust war movies back in the 70s and 80s. That's all I'm gonna say.
At some point while you're pontificating about something, I'm gonna look the name of that up, or it's gonna bug me. But anyways, we're gonna break this down, and Matt, different areas of the market, because. And this is going to be a constant theme that we talk about in the next hour. There's separation. There's different technical formations. There's different behavioral things to examine. And understanding technical analysis during this next week or two is going to be really huge in determining where you flow your trades, right? There's going to be certain areas based on the technicals. You're like, I don't want anything to do with that, right? And there's gonna be other areas you're like, yeah, I need to, move some trade, some flow into that. Technical analysis is gonna play a huge role. We have a master trader event this week where we will lay the foundation of technical analysis for you. Matt, how are you doing? And tell me a little bit about this event.
Yeah, doing absolutely fantastic. Excited to be here with another edition of the pod, and always looking forward to a conversation with you, my friend, on all things market activity here in the Trading Justice podcast. And if you love the pod, best way to support the pod is giving a nice little review, and on any platform that you either watch the pod or listen to the pod as well. Like and share always helps as well. But Master Trader's coming up on Monday and Tuesday. It's free for our pro members, so all you have to do is hit the link in the description below and sign up for a free trial membership of the pro membership of Tackle Trading. And not only are you going to get an amazing tackle trading newsletter that we just released, the latest edition, get the traders report. We just released that latest edition, get the hottest trading picks, ideas on a week in, week out basis. But you also get access to this Master Trader course, which is the absolute best introductory course for new traders or traders that are coming back to the market, wanting to pick up the skill set or enhance their skill set on either learning technical analysis, breaking down charts, or obviously on learning how to trade options as well, buying calls, buying puts, selling calls for cash flow, selling puts to enter into naked puts and bring in cash flow as well. That's all in Master Trader, and we're going to teach the next edition on it on Monday and Tuesday this coming week. So definitely check it out. And once again, all you got to do is hit the link in the description below, and that'll take you to the landing page where you can sign up for a free trial and get access to Master Trader.
Yeah, Matt. So we have the election, right? And we've had a lot go on in the last few weeks. We've had the election, and this is going to be a little bit different because we're going to do some intertwining of charts here. And what I want to do is, after the election, we had a surge in a lot of areas, right? Like especially that day after, everything's euphoric. A lot of that euphoria lasted for a trading session or two. And then we had a little game show edition of who's telling the truth and who might have been fibbing on that initial move. And I think we're having another one of those now on the sell-off, of that not everyone selling off is telling the truth either. And that's where, I want to get your technical what to look for on what downward charts to end the week might be lying a little bit, where they might be, finding support sooner than later. But I want to start with the areas of the market that surged and then been telling the truth, and get your technical read on them. I want to start with finance, right? We had on our scouting report picks, a lot of picks in finance. Once again, one of those surge, and then as we talked about in the podcast, just kind of exhibited control, kind of telling the truth on that initial surge. What's your look here on finance?
Yeah, on finance, I think it's interesting that the topic, the things that surge versus the things that are sticking. Obviously,
sticking, that's a great word for it. What's sticking?
When
right?
you have a technical catalyst event where the entire market is focused on that event, and obviously the Fed, fits that bill, but obviously the election being a major part of that. And the reason we kind of gapped up was due to the election. And once that gapped up occurs, it doesn't matter what you're really looking at in the moment on a catalyst like that. Everything's going to move in tandem with one another. And we've seen that across the board, regardless of the index you're looking at, whether you're looking at the S&P or the Qs or the IWM or the diamonds, they all did relatively the exact same thing. For example, the IWM small and mid caps, they went up really aggressively, but they're coming down a little bit more aggressively. You look at the diamonds, they went up a little bit less aggressively, and they're coming down a little bit less aggressively. You look at the Qs, they went up a little bit less aggressively, coming down a little bit more aggressively. The upward surges versus the downward profit-taking environments are really telling you what is kind of the areas that were really part of the Trump trade. For example, the NASDAQ was never really part of the Trump trade. In fact, there is concern over the NASDAQ, but the NASDAQ, and specifically due to tariffs on China and how semiconductors would perform in that environment, and semiconductors have been a little bit of a problem child, in the market. You look at the Qs broke out. You look at XLK didn't, came right back down. You look at SMH, which is the actual semiconductors, and you really didn't get any participation out of the semiconductors. And so when you're looking at what was real versus and what is going to stick versus what was just kind of getting tagged along for the ride, I think you can really look at the Qs as one of those situations where, up, just along with everything in the cyclical side of the equation, but obviously showing a little bit more velocity on the downside. And so honestly, when you're looking at the marketplace and trying to determine, okay, what areas of that initial surge due to the Trump trade were legit and are going to stick, I think you actually got to start at the index side of the equation, because the Qs versus the diamonds, for example, tells you a really important story. The Qs had less liftoff and more volatility to the downside. What does that tell you about tech in comparison to the cyclical side of the equation? The cyclical side of the equation.
It's a huge takeaway from this week, isn't it?
It is, because not only did the diamonds have better liftoff, but it had more controlled pullback scenarios as well. And so you can look at the diamonds here and just be like, oh, yeah, we got a profit-taking environment, bullish retracement coming to the breakout channel. And you can rinse and repeat what I just said on all the indexes, but some of them are hovering against that 9 EMA. Some of them are right around the 20 SMA. Some of them have actually violated the 20 SMA, like the Qs did on Friday's volatility. And so the cyclical side of the equation versus, say, technology has held up a little bit better. So when you do come into those cyclical areas of the market, like finance, which is one of our, I think finance is our highest rated cyclical sector out there. It's not as high as what we have communications or discretionary, but it is one of those areas of the market that certainly stood out in post-election analysis. Not only did you have that same degree of upward movement in price, but Mark, whereas most of the indexes, including the Dow Jones, including IWM, which is chock full of either major center banks, regional banks, obviously the major money banks are, in the Dow Jones, the regional banks are in IWM, but they pulled back. The diamonds did. The diamonds pulled back, but finance itself didn't. Finance itself hugged up at the top end of the trend, forming a little bit of a clean high base, showing not a lot of concern, not a lot of volatility. And finance obviously is one of those areas that is part of the Trump trade. And as that was part of the Trump trade, not showing a lot of volatility here at the top of the chart, looking pretty good on finance.
Yeah, energy also part of the Trump trade, widely regarded. These are probably two of the clearest deregulation Trump environment winners, right? And both of them, listen, oil had
and I think it's a large percentage of the deregulation movement in finance and energy versus any other sector out there.
Yeah, and you look at oil, and Matt, would you agree with this statement? like, the market is about to go through a truth telling phase, right? At the end of the week and in the coming week
Oh,
or two.
absolutely. Following catalyst events, what's real, what's not real. These types of conversations we're having right now is absolutely important.
Yeah, because this is kind of this truth telling phase, and things that want to sell off that maybe weren't, that were just getting caught along with the ride, starting to see separation. But energy was really telling on Friday, right? You had oil down, right? You've had commodities in general weak, right? And we'll talk about that as we go through the podcast. But energy itself just refused to get caught up in any of that weakness, right? A different type of pattern, but it's energy, right? No, is energy. What's your technical look? What's your behavioral look at energy this week?
It's a choppy look on energy, and I think that's to be understood given the fact the backdrop of what energy has been going through over the course of the last 4 or 5 months. Honestly, a lot of wide range volatility, but and I still see that on the chart, but I also see an improving condition. I see a breakout, and I see energy moving better than what we have been seeing in recent history. And I'll just give you a little bit of conversation that I was having in the tackle trading newsletter this weekend that was just released here today. And I was talking about energy in the sector rankings part of the video, and I'm not going to go through in the exact same detail that I did for our pro members in the newsletter. But at the end of the day, when you're looking at energy, and obviously energy is one of those areas of the market that is based on the Trump trade, based on deregulation. You have oil sitting at a low point. If oil starts to get a bid, you're going to see a little bit better pricing coming from a fundamental side on the energy conversation. But over the course of the last week and a half, ever since Trump won the election, you really haven't seen any downward pressure in price on energy, very similar to what you're seeing on finance. And before that event, Mark, what you saw on energy specifically is, for example, in the last year, Mark, energy is the worst performing sector in the past year. In the past, and it's been a really good year for the market. Finance up 40%, tech up 38%, energy up 7%, but it's still the worst performing area of the market over the last year. Over the last half year, energy's up, it's down actually negative 2% over the last half year. Over the last 3 months, energy's only up 0.15%, 0.15%, basically a doji over the last 3 months. So over the last 3, 6, 12 months, energy is towards the bottom of the pack, if not the worst area of the market from an overall, percentage gain perspective. But Mark, quietly over the last month, energy is the fourth best sector. A lot of that is due to energy over the last week being the second best sector, and over the last day being the fourth best sector. And so over the last 12 months, 6 months, 3 months, energy is one of the worst performing sectors. Over the last 1 day, 1 week, 1 month performance, energy is one of the top producing sectors. What's the difference? The difference is the catalyst that occurred under Donald Trump winning the election and energy getting that bid based on the deregulation environment. Remember, for the last few years, energy was always based on catch up of crude oil in the recovering conversation. That changes now to a deregulation environment, which means you don't need oil to start cooking to get energy to do this catch-up phase. You can actually start to look at the fundamental environment and say, wow, we're still dealing with the lowest valuation area
and
of the
this
market.
Is a huge,
and
huge
now
deal.
You have a deregulation argument, which means you don't need crude oil to go up, baby, up. You just need drill, baby, drill, and that would increase the fundamental revenues of all of these energy companies. And when you look at energy from a fundamental perspective, this is extremely important because energy was the worst producing sector from an earnings perspective. They had a terrible blended growth rate. Revenues were basically down year over year. A lot of these energy companies were negative on the year over year growth perspective. And now you can start attaching a deregulation argument, which is basically an efficiency argument for these energy companies. And so despite the fact that they've had terrible performance in comparison to the rest of the market over the last year, that's changing over the last 2 weeks, given the fact that we are now seeing that deregulation argument play out. And now you can start actually considering the very low valuation component of this energy conversation. And so I do think energy gets on the radar very quickly for anything secondary. Pattern watch. You got, and quite frankly, whereas most of the cyclical areas were doing really good over the last 3, 4, 5 months, energy was the one that was not. Energy is now the one that is performing very similar to finance, very similar to industrial, and it's coming from a very lower point on the chart. I kind of like energy in that position.
No, and this is the aftermath, and this is what I wanted to do in this podcast is be like, because last week we talked about, I'm going to give you a couple areas on an industry level here, right now here in a second, but it's like, all right, and we talked about this in the podcast last week, Matt, control, who's exhibiting basically orderly behavior. That was a big, huge deal for us in the evaluation of things, right? Finance, we're seeing that orderly behavior. Aftermath, hey, checks all the boxes. Energy, that's about as orderly of an environment considering what crude oil does as you get.
Well, and again, it's still choppy, right? But it's choppy up instead of choppy everywhere, and that's a change of characteristic, especially when you held the breakout channel of 94 last week.
And what I'm starting to do, Matt, in my evaluation is like, all right, sector analysis, because you and I are both top-down guys, right? What's markets doing, and we'll take a look a little bit deeper here.
How many times I said it? You get the indexes right, you get everything else right.
Then go to sector, but now I am starting the process of going to industries, right? The areas within an area, because like, let me give you XLI, for example. XLI, kind of messy to end the week, right? Very could easily bottom out here thing, but I'm starting to go within the thing. When I look at airlines, and give me jets, and then you can look at Delta or Southwest. I'm not seeing that volatility. Within the industry group, I saw a surge, and I'm seeing, some general, hold the thing. And I look at Delta, I look at Southwest. I didn't see volatility in these areas to end the week. That stood out. When I
see a really good breakout channel at 25, quite frankly.
Yeah. And so, looking at industry groups now, right? We'll talk semiconductors on the negative side here in a second, but like, the sector, but now what areas are really standing out as, that order, that control? I look at American auto manufacturers, right? Ford, GM, right? And Tesla's its own right thing, but these are some of the better controlled patterns, right? Big surge, right? Exhibiting more control. And so this is what I'm looking for right now on that more micro industry level that then can lead to a lot of individual trade components.
Yeah, I really don't have anything to add there other than that's exactly how the process of top-down works. You assess the indexes to set your bias. You understand the sectors to understand which patterns are starting to cook in that sector, and then you go into the industry group. So, I don't really have anything to add on the industry group side of the equation.
No, and playing off of that, just coming back around to energy real quick, like when I look at producers like Oxy or Apache, right, I'm not seeing as good of potential development, right? So like on energy itself, I'm like, I look at the producers and I'm like, right?
Well, you're also talking about two stocks that had negative earnings though, too. So like I'm very familiar with these two stocks. Apache had one of the worst earnings out of the energy space, wasn't really close. Oxy had a negative earnings report and one where honestly, I openly questioned whether or not Buffett was still going to stick here. And so,
give me Devon then. Devon had a decent earnings report, but it's exhibiting the same thing, right? Like
Devon did have a decent earnings report, and it is showing a very, very similar thing on the producer side.
But Exxon, Chevron, midstream companies like ET, like these things, are exhibiting a different flavor, right? And so like I go into that little industry group and I'm like, all right, energy, I can play XLE, right? Or I could go look within XLE and see where the true strength is. And I think that's I think that's part of the trading process right now.
100%. Especially when you're talking about energy, because the producers versus the service companies versus the drill baby, like energy's a different beast than say some of the other sectors that kind of just go with what the sector does. You will have separation in the energy sector, no doubt about that. You're just talking about one of the better companies in energy, quite frankly. It's a very good company in energy.
And so that process, and we help our members, identifying individual trades for the trade setups and the traders report every week at Tackle Trading. But I think this is part of the aftermath process, and I think it's a big process that will continue in the coming weeks at identifying strength, sector level, top down approach on the markets, and then on industry level. And I think that's for me the rest of 2024 is this process, because
but for me, I really don't spend a lot of time breaking down the industry groups. Honestly, I spend a tremendous amount of time breaking down the indexes and sectors. But when it comes to the way I scan, I never have to look at industry groups because I broad base scan. And when we broad-based scan, we find the best technical setups regardless of the condition, and that's what we put on the traders report.
For me, I just like consistent. Like if I see all the airlines consistent, like it makes me feel better. It keeps me warm and fuzzy at night on it.
One of the most consistent charts in the market over the last 2.5 months is that Jets chart.
Yeah, it's a pretty one. It's a pretty one. Now on the flip side, right? You have some downward pressure in things like small caps. I don't know what to make of it. And so I'm waiting for, individuals that have, expert technical analysis, because small caps, theoretically a potential winner under the Trump administration. But the chart is a lot
in front of yields. So if yields are going to go up, small caps are going to be capped out. And that's the concern on small caps. But again, I want to be very clear on the pullback here on small caps. It looks nasty on the pullback, right? You look at the last three candles and big red, big red, big red. Well, okay. Should that be a vastly different read than the S&P 500 itself, which is doing the identically same thing from a technical perspective? The only difference between IWM and SPY right now is the velocity of the moves up and the velocity of the moves down. But from a percentage perspective, you're looking at very similar type technical situations. And so the visual can be a little bit off-telling, quite frankly. When you're looking at the upward movement in price, you're currently sitting at a 50% retracement against the upward movement in price in the immediate short term, just looking at the immediate short term. When you look at IWM and you do that exact same thing, you're at a 50% Fibonacci retracement against the immediate price movement, maybe slightly more than a 50% price movement. My point is, despite the volatility you're seeing on IWM over the last 3 days, the technical read on IWM is very, very similar to the technical read on SPY. SPY broke out of a multiple time frame situation on a catalyst event, Donald Trump's victory on the election. S&P broke out, IWM broke out, Qs broke out, diamonds broke out. All four indexes broke out simultaneously. Some had better momentum. Diamonds had good momentum on that breakout. IWM had good momentum on that breakout. The pullbacks now. Let's look at the pullbacks. The pullback on IWM is pulling back in between the 90 EMA and the rising 20. That is known as a bull zone, where you could expect some degree of pivot formation to start occurring. We want to see a little bit of slowing momentum in that environment first. But where are you at? You're right at the previous breakout channel. You're coming down to retest that breakout channel. And if you get a doji upward movement in price, that would signify an increase in support against the backdrop of the multiple time frame breakout. That's not a bad look from a technical perspective, but you got to see that pivot formation occur.
One of my big questions for you is on these pullbacks.
Let me finish my thought on SPY though. What do we got? We got a breakout. We got an overextended. We got a pullback down to the rising 20 period moving average in between the 9 and the 20, right to the previous pullback channel. It's the same technical read. It's the exact same technical read. The only difference is you have a little bit more momentum on the top side, and you have a little bit more aggressive profit taking on the downside. And the upward movement in price was obviously the euphoria of the small and the mid caps and the America First messaging coming out of the Donald Trump victory. But the negativity on that is there's a reality that has to set in on small caps. And the reality that has to set in on small caps is you can't fight a yield conversation on small caps. That's the number one thing you cannot fight, is increasing yields on small caps, because small cap stocks need debt to finance their operations. And whereas the larger cap stocks do not have to deal with that, the larger cap stocks have to deal with the rising dollar and how much they're going to have to give up to Europe and Asia in that. And so there's concern on both sides of the equation there, but the concern on IWM is quite frankly the rising yields, and if that's going to impact their ability to finance their operations moving into the future. And so you're just seeing a little bit more concern on IWM over the last 3 trading sessions because of the strength of the dollar and the yield conversation. But Mark, what occurs if the dollar holds that resistance level that we've been breaking down for the last 2 weeks? We've been talking about that 106, 107 level holding. Well, what happens if that level holds? We're staring down the barrel at that level right this very second. Well, if that level holds, I'm willing to bet that everything in the market looks a little bit better, regardless of what we're talking about. I'm willing to bet you'll see a pivot formation on IWM. You'll see a pivot formation on the SPY. The Qs will get a little bit better, but at the end of the day, like, the anchor against the dollar here is going to be extremely important to see what these secondary patterns truly do look like.
And this is one of the questions I have for you in the podcast, because, first thing we talk about these areas that are sticking, right? Market telling you that, yes, they surged, they're sticking, right? Giving you a clear signal for a round of trades. But my question for you is, and this is a question I have coming into the week, is that we have these pullbacks, right? To end the week, industrial, small caps, tech, right? Do you expect to see potential separation in those, where maybe, some of those areas start performing better than others, where, maybe tech suffers a little bit, but industrials or small cap, like, could there be separation within the pullback now to have the market tell us that, yeah, well, this was maybe fibbing on the way down?
Absolutely. The depth of the retracement is such a vitally important conversation into understanding what areas of the market are real after the catalyst event and which areas just got carried in that moment. And so absolutely 1000%. In fact, Coach Frank in the Traders Report this weekend talked about the depth of the retracement. And when you're talking about the depth of the retracement, Mark, when you there's certain levels in a retracement that you track. You track the shallow retracement, the standard retracement, and then the deeper retracement. A shallow retracement is a momentum-based pattern. We're not seeing those in the market right now. What we're seeing is standard retracements right now. The volatility is a little bit different. For example, IWM's volatility is a little bit more concerning than the SPY volatility on this pullback. I would say the SPY pullback is just a standardized pullback, quite frankly, at this point. Whether or not it confirms and gives us a great pivot formation and a great trade this week is a secondary concern. But at the end of the day, the pullback in SPY is a little bit better than the pullback in IWM. The pullback in the diamonds is a little bit better than the pullback in the Qs right now. And so, yes, you can see separation.
And would you put industrials in there with the diamonds?
I would put industrials with diamonds right now. I wouldn't put it in with IWM. I think you put it in. It certainly doesn't have the consistency of energy and finance right now. That is kind of the strength of the diamonds. I mean, when you're looking at the diamonds right now and saying, all right, this 3-day pullback down to the breakout channel right around the 90 EMA, that looks really, really good from a diamonds perspective. And when you're looking at the diamonds, it's really energy, finance, healthcare. Yeah. It's these cyclical components of the market. And so the pullback you're seeing in the diamonds is kind of one of those shallow pullbacks versus standard pullbacks we're seeing in the rest of the market. And that's because finance is in a high base right now. Energy actually went up this week when the market was pulling back. And the one concerning area of the diamonds would be healthcare. Healthcare is that one concern where you're like, oh my goodness, that is putting a lot of pressure. And so, healthcare is putting pressure on the diamonds, but the diamonds looks good. So what else is in the diamonds? Finance, energy, industrial. And so all of those three offset what we're seeing in healthcare. So yeah, I would put the diamonds into that shallow pullback scenario. Obviously, when you're looking at the components in the Dow Jones, finance is in a high base, energy is in a multiple time frame, mid-tier breakout, looking pretty good, quite frankly. And then specifically industrial, you're seeing a slightly different pullback, but very similar. You're not seeing anything too concerning in industrials, finance, or energy right now. The concern in the diamonds is specifically and rightly on the healthcare side of the equation in the short term, Mark. But I think those news stories are going to be changing in healthcare. I have a different opinion of healthcare. But from a technical perspective, no, diamonds looks really good right here at the top. A little bit of a shallow pullback.
Yeah, no, and this is a huge, massive gathering of information time period, right? And this process of what's sticking, okay, we know that unless something changes, to assume that's going to go. But this little separation, these pullbacks are going to provide opportunities. They might not provide pullbacks opportunities in every area, but I would be very, very surprised if some of these retracements don't provide some really good trades in the coming weeks.
Anytime a bullish retracement is occurring in the market, you have to think about pivot formation, support builds, and opportunity. If you're thinking about, scared, concern, you're in the wrong business.
Yeah, and so it's like watching that separation, we'll break that down every day in the tackle today and in our Traders Lens in Depth, like looking for
pullbacks are opportunity. They are.
Finance
trades opportunity.
They're just opportunity, and which one provide that opportunity, I think, is a big story for the coming week. Now, Matt, you mentioned healthcare, right? Now, one of the things that you've told me a few times along the way in the podcast, healthcare had pretty good earnings. It is easy to forget that we've had earnings the last couple of weeks, accumulating a very, busy earnings season, right? It's become a forgotten story, and markets tend to do this, right? They're like, all right, earnings are all important. Oh my goodness, we have something shiny. We need to focus on that. And the election of Trump, rightly so, right? But, where are we as earnings season is now officially over? We have Nvidia here in a second. I'll talk about that here in 1 second. But how has earnings season been? I always like to know where blended growth was. You provide that information that is very valuable for me from just a fundamental perspective. You mentioned in the newsletter, I read your earnings section every time in the newsletter every week, that revenue numbers were a little off. My first question for you is big picture, and then I have a couple minor questions. What is your letter grade just overall take from this earnings season, which almost nobody's talking about right now, but I want to talk about it because it's important.
Listen, as the dust settles from the election and the Fed and all those economic reports over the last couple of weeks, the real truth of the market is always earnings. It's always what these companies are actually producing, not what everybody's talking about it. And so you're right, nobody's talking about earnings, but you're seeing earnings play out in the market. No doubt about that. But it will have a greater impact as we move a little bit away from the volatility of the last couple of weeks. In general, I think we're probably slightly below average on this earnings season. I thought it was good enough to hold up the market. I didn't think it was good enough to propel the market. And quite frankly, my opinion would change based on the sector we're talking about. But at the end of the day, I'd give it a B minus. I think it was a very average earnings season.
Do you have a couple sector standouts, good or bad, off the top of your head?
Yeah, I mean, if you're talking about the best producing sector from an earnings perspective, I would have to say that was communications. Communications was a standout from the word go in this earnings season. I haven't seen a lot of flaws in communications, quite frankly. Let me just kind of review some of my notes very quickly. EPS beat was 95% on communications.
That's by far the best, right?
Yeah, well, you had close to 90 on a couple sectors, but communications was the best. EPS surprise was the highest as well. EPS surprise is the percentage of the beat. So earnings are always low bar expectations. So everything is based on expectations and not based on what they actually produced last quarter or anything like that. It's always based on what the expectations are. And so if somebody expects 10 cents on the EPS, then they come out with, 14 cents, that's a 4-cent beat, right? Well, and that would be what, a 40% beat. Well, the typical average beat in the market this quarter was 4.5%, Mark. Over the last 5 to 10 years, the average EPS beat in the market is right around 8%. And so right now you had an average beat rate against EPS expectations of right around 4.5%. Communications had a beat rate of over 11%. And so not only did they beat by 95%, they destroyed EPS expectations out there by over 11%. Revenue growth was the third highest of any sector out there at 9% year over year. Blended growth was what came in at 23%, which was the best sector out there from a blended growth perspective. Profit margin improved from 13%
Did you just say
to
they had the best
14.7%.
blended growth?
Blended growth was 23% out of communications. And then, Mark, 4 of the 5 subgroups out of industries, you were talking about industries, 4 out of the 5 subgroups are showing tremendous growth metrics out there. And so like when you ask me the best sector producing out of this quarter from an earnings perspective, it's communications by a I don't want to say Grand Canyon wide, but it stands out. There's no doubt about it.
And this is why I listen to the podcast and I read the newsletter and stuff, because this is the point in the podcast. If you're listening right now, you should be making notes that, hey, if I get, because once again, we were just talking about things sold off at the end of the week in a lot of different areas. That's probably not going to continue in all areas, right? Some of those are going to form. If I see that technical doji signal, right? If I see a couple of days of support build, right? And then some in communications, boom, hit the trade, right?
Well, and it wasn't just communications that stood out. I also think consumer discretionary stood out as well. XLY, all those retail stocks out there, and XLY has one of the better technical setups going into next week, in my estimation, is the retail space. And when you're looking at XLY specifically, they had the second best beat rate, third best blended growth, third best revenue year over year, just had a really good earnings season as well. Had a couple standouts out of discretionary, in my estimation. GM was a standout, but there was others. Tesla was a standout in discretionary. Amazon was a standout in discretionary. When I'm looking at some of the other standouts, just kind of let me look at my notes very quickly. Just kind of off the top of my head, GM, Disney came out with a 4.6% beat, raised fiscal guidance. They stood out on that side of the equation. Shopify was a standout. Spotify was a standout. Amazon. And so there were, like, on the top 20 earnings reports of this quarter, I would say 5 of them came from discretionary.
Oh, so discretionary. Any dogs, like anyone stand out as a dog on a sector level?
Well, before I get into the dogs, just one thought on healthcare very quickly in terms of healthcare. Just let me get back
To be fair, I could do a whole podcast on the healthcare sector right now.
Yeah. Yes, it is a vastly it's a vast conversation in healthcare.
Yeah, listen, Robert Kennedy was nominated as the HHS secretary. He's had some very anti-vaccine moves. Healthcare blew up. The second he was nominated this week, healthcare biotech, it just was pure volatility, pure volatility. Obviously,
I think we're seeing it. Listen, I do have opinions on that, but not to share in this podcast. What I will say is this. I think we're overshooting on healthcare. I think we're overshooting on the concern of healthcare. Healthcare is the worst sector in the market right now. The absolute worst sector in the market right now, from a performance perspective, from a technical perspective, from a where in the hell is this place going perspective. But Mark, I would have to put healthcare in the top 3 of the best sectors from an earnings perspective. I would have to do that. If I'm being intellectually honest with the fundamental conversation of earnings, despite what we're seeing on the sell-off, and I respect the sell-off, don't want to pick up a falling knife here. But Mark, I do think we should keep an eye on reversal formations happening in healthcare. And I doubt that's going to happen in a day or two or this week. I'm not saying that's a this week conversation. Reversals take a little bit of time. But Mark, they had the second best EPS beat rate this quarter. They had the third best EPS surprise percentage beat this quarter. They had the second highest revenue growth this quarter. They had the second highest blended growth in the quarter as well. Multiple companies stood out, and 4 of the 5 subgroups obviously stood out as well. That's not too dissimilar to the reports you're talking about coming out of discretionary, quite frankly. And so, respect the volatility, but this is not a fundamental earnings sell-off here, and that is my point. And when it's not driven by fundamentals, and when it's not driven by earnings, when it's driven by hypothetical concern that may or may not manifest itself,
that's a good call.
That's one thing, but let that play out. But when it does play out, realize there are good fundamentals here in healthcare. There's just concern.
After the first Trump victory in 2016, healthcare had some volatility, traded sideways for a couple months, and then had a monster trend that followed for about 10 months. So wouldn't be surprised to see some version of that play out again.
I thought they had, listen, they never once throughout the entire time, even before Trump was elected, they didn't have good price responses to their earnings throughout healthcare throughout the entire season. But the raw numbers are there. The raw numbers are there. So when we do see reversals, realize that this is not based, the selling behavior we've seen over the last couple months, it's really not based on earnings. It might be based a little bit on revisions of guidance for 2025. Let that play out. But again, I don't have a negative opinion on the fundamental side of the healthcare conversation right now.
Give me a dog or two from earnings from just a sector perspective.
Materials, XLB, it's been garbage all quarter long.
And the nice thing about XLB, it never gave you a signal. It gapped up with everything, started to sell off, and then never ever deviated form.
No, and obviously ever since the election, the dollar has put a lot of pressure on basic materials, right? A tremendous amount of pressure on basic materials. That could be coming to a conclusion. We'll have to wait and see that dollar if it does break out. But on materials, it had a 50% beat against EPS, which is downright awful. That is awful. That is absolutely awful. EPS expectations are always low bar expectations. Remember, the average EPS beat in the market is 8%, is the average over the last 5 to 10 years. You base and the average beat on EPS just in terms of net beat against an EPS expectation is like 75, 76%. Basic materials beat at an average of 50%. EPS surprise, Mark, remember 8% is kind of the baseline. -7% here out of basic materials. Blended earnings growth. You love blended growth. I remember years ago when I started doing blended growth, it took a little bit of time for that to cook at Tackle Trading. And for the first 6 months, you're like, what is this blended growth you're doing? Tell me you don't anchor against it now. Blended growth is
these conversations, Matt. Let's just recap the podcast to this point. Things that are sticking, I know to trade those, right? Things that are pulling back, there's probably going to be separation. Technicals are going to tell me what to trade, probably some really good opportunities, right? And then the fundamental conversation we're having here on earnings, give me confidence and break tiebreakers in the trades I make, right? This is the approach, and it leads to a lot of success.
So I would say basic materials was probably the worst producing sector from an earnings perspective. A lot of the specialty chemical companies, which is a lot of basic materials, didn't play out. And then secondarily, you've had a lot of negative impacts due to the dollar on the commodity side of basic materials as well. That's pressed it down pretty aggressively. You're also coming into the 200-day moving average. And so I don't have a strong fundamental conviction on basic materials. But man, if the 200-day moving average holds, I'm going to start liking gold a hell of a lot more.
Yeah,
Gold
listen,
stocks, that is. Gold
we'll
stocks.
talk about here in a second. Listen,
Yep.
we're 45 minutes into the podcast.
Yep.
Nvidia has earnings, and we haven't mentioned them yet. That would not have been the case any quarter in the last 6-7 quarters, where Nvidia would have been like, hey, it would have been mentioned 4 or 5 times, if not had a special segment. There is a sense in the market that Nvidia's earnings aren't as important to the market as they once were in the last couple of years. Would you agree with that general statement?
No, I wouldn't.
Okay, tell me why. I thought that would be your answer.
Because it's freaking Nvidia. It's the number one growth stock in the market. It's the number. Who said that?
Lots of people out there, right?
Okay, look at the blended growth of the S&P 500 if you discount the number one growth stock in the S&P 500. I'm sorry. Yeah, I get why they're saying it. It's like, oh, we've been talking Nvidia for 2 years. We're exhausted. No. Yeah, I'm sorry.
I didn't prep Matt on this question because I knew I would get a natural reaction.
Absolutely ridiculous. This is the number one stock from a fundamental perspective, from a thematic perspective. If you want to see this market pivot, you want to see Nvidia beat their EPS, beat their revenue, year-over-year revenue growth of 40%, and an increasing in forward-looking guidance. Because if you don't get that, everything in the market's going to sell. And then everybody's going to be like, well, Nvidia is kind of important, isn't it? Yes, Nvidia is the number one most important stock to the marketplace. And anybody that discounts that does not understand the power and the potential of what Nvidia provides to the macro EPS revenue blended growth. Mark, if I take Nvidia out of the equation, I can't do macro analysis on earnings. That's how important Nvidia is. I can't believe anybody would say that. What, exhausted with how much money Nvidia has made in the last couple of years? Are we serious? That's ridiculous. That's absolutely ridiculous.
I did not prep Matt on that question because I knew I'd get a natural reaction, and I was 99% sure that would be the reaction I got. Well, they have earnings. I think it's Wednesday after the bell this week, and if they have, once again, there's been a lot of moving parts in the aftermath, right? And a lot of things forgotten. The beautiful, charismatic CEO of Nvidia, you have likely forgotten, not you, Matt, but lots of people.
Who forgets
the comments he made over the last month and a half pointing towards
insane demand on the Blackwell chip, for crying out loud.
If you're listening to the podcast, you've forgotten that, right? You're like, oh yeah, he did say that, right? There's been a lot of things going on, right?
Or the CEO of Foxconn coming out 2 days later and saying, yeah, we are seeing insane demand on the Blackwell chip.
And you and I have said, there is almost no way Nvidia's upcoming earnings 5-6 weeks from now, I remember us having these conversations at the time, probably aren't really, really good, because if he lies about that, that's really, he's a smart guy. He's a brilliant guy, right?
Jensen
he's not going to
brilliant individual.
He's not going to lie about that, knowing that, oh yeah, sorry, we undelivered.
Now that does not mean Nvidia goes up on earnings.
No,
right? That is not what that means, and I want to be very clear on that, because Nvidia is beating everything and that's built into the earnings analysis.
Yeah, because they're very well.
I'm going to tell you right now, if Nvidia comes out with an 8% beat against EPS and a 10% year-over-year revenue handle and a slight uptick on forward, or a reaffirming of forward-looking guidance, Nvidia is going to sell, and it's going to bring semis down. It's going to bring tech down. It's going to bring the market down. Now, does that create a downtrend or just a volatility pocket? That's a different conversation. That's a technical conversation. But to discount the importance of Nvidia's earnings report, oh man. Oh.
Yeah, and this sets the stage. Tech down a little bit if Nvidia delivers, because listen, I know there are areas, and I don't have any tech exposure heading into Nvidia's event. I'm looking at all of the things that are winning right now from a trading point of view, because that's what I should do from a technical perspective, from that. But I do know that markets are easier when tech's involved. They just are. Trading is easier when tech's involved. Just look at Friday, right?
You don't get consistent, amazing trends without tech.
You can have little pullbacks in tech, orderly pullbacks, and have other things. Yeah, we've seen those over tech's important. right? It makes everything else easier. It just makes everything else easier. And
I
so we're
want to
going to
meet
get,
these people that said Nvidia was not important.
well,
I truly, I want to meet them.
how
I
about gold
want to
people?
ask them what, like, I just have questions. I have questions.
Uh, people
I just don't get it.
names that have discounted the upcoming importance in Nvidia's earnings include Goldman Sachs, JP Morgan,
I know the
Morgan
names.
Stanley,
Mhm.
right? Just like, hey, no, this we don't need to worried about something else right now, right? Yeah.
Well, how does trusting the banks work for people long term?
All right. One of the things that has also been sticking, we've talked about it 6 or 7 times in this podcast already, is the dollar. This has been a big, huge move up. Big, huge move up. It is at a place, it is overbought. And yes, blah, blah, blah. Things can stay overbought longer than you can expect. I get it, right? Well, I've been around, I understand. But man, this is a logical place to take a breather. We don't have a lot going on the next couple of weeks from an economic front, right? There's not like that catalyst event that can, unemployment, inflationary, right? We had inflationary data. I'm not going to spend any time on it because it came in line. But just this is a point where you take a break, right? No economic events on the horizon the next couple of weeks of tremendous significance. You're in overbought. You've had a massive run. I get it. Dollar stronger under Trump, but man, you're just from a technical perspective. This feels like it takes a breather.
I felt that way for a few times on this move up over the course of the last few weeks on the dollar. Some of that was, hey, I hope we see a little bit of hesitation here. We just haven't seen the hesitation in the weekly chart. We've seen momentum, and that momentum has continued until you got to 107. And at that point, when we did get to 107, which is a major level of resistance, you're starting to see a very early signs of resistance playing a little bit of a role. But we're still dealing with an uptrend. We're still dealing with momentum in the uptrend, and there's still concern there on the dollar. If a break here, Mark, I have a very hard time believing that we'll get a great pivot in the market, which is setting up for a great pivot in the market if the dollar breaks here. The dollar
Listen,
has started playing a
it's a
role,
fact.
not just on the commodity side, which is easy to see. It's starting to play a role on the actual S&P 500, the Qs, some of these large cap stocks. You're starting to see it creep in a little bit, not a lot, but you're starting to see it creep in a little bit to the concern on the earnings side of the equation. And that's where the concern on see, the dollar is always going to be a concern against gold because the dollar has a divergent relationship against gold. It doesn't always have a divergent relationship against the S&P 500. But when you're talking about this parabolic movement in the market, that you've also seen yields go up right along with that, that's obviously going to start becoming a bigger concern the higher it goes, because you're not just seeing the dollar go up right now, you're seeing yields go up right now too. And as yields go up and the dollar goes up, it's harder for these companies to get out there and produce the types of revenues you need to produce to maintain those year-over-year growth things. And so what you're starting to see very, very early is you're starting to see revisions in earnings going into the first quarter next year, not the fourth quarter. Fourth quarter EPS revenues look really, really good so far. But you're starting to see a little bit of those early signs on earnings revisions out of large cap stocks in the S&P 500 based on the dollar. Mark, if you see that break out, and you see that run, I'm willing to bet you start to see more and more companies start to inform their investors and their institutional holders. Hey guys, we got a little bit of concern. If the dollar continues to go up, we're gonna have to start capping out our growth expectations, because once again, we don't just deal with the economics in America as in the stock market. 50% of the revenue of the S&P 500 companies comes from outside the United States. As the dollar goes up, it puts pressure on those countries' currencies, which have a hard time buying our goods, our services. And so is that a concern at 107? Not necessarily. But is that a very big concern if you break out of 107 and you have to think about, oh my goodness, is the dollar going to go up to 110? And if the dollar goes up to 110, that means the euro's at paring. And if the euro's at paring, Mark, We've only been a pairing just a few times since 1999 on the euro dollar cross pair. The euro dollar cross pair usually lives about 10 to 20 cents higher than the dollar. Now you're close to pairing right about 104 on the euro dollar cross pair. You see a breakout here, yen gets a lot worse, puts pressure on the Japanese economy. The euro gets a lot worse, puts a hell of a lot of pressure on the European economy, which does not need any pressure right now. You break out here, all of a sudden, guess what China has to do? China has to start manipulating their currency market a little bit to make sure that their soft peg still works against the dollar. And so you just got some major concern here. But again, that major concern is not at 107. It's if we break 107. And so a lot of the last 2 weeks, not 2 weeks, but like a week is just kind of, there was this magnet at that 107 level on the
there
dollar.
was. You say this all the time, Matt. When a support or resistance level breaks, charts, they just tend to go find the next one, right?
Because nobody fights it until it does.
Because nobody fights it until it does.
Because nobody wants to fight it until it does. Why stand tall against the freight train of the $5 trillion currency market? And so, yeah, there was a magnet up there, and it's obvious to see, looking back, it's obvious to see nothing stopped it until it got there. And then when it got there, we saw a big random wick at 107 2 days ago, fight back up there yesterday or 2 days ago. And then yesterday we saw that kind of play out again. And so, it's going to be interesting to see what develops here on at 107. But just what I'll say to everybody is this: everything you like in the market, every single thing you like in the market will either be beneficial or deteriorating based on what happens at 107 on the dollar.
Yeah, I know. And it's one of those things that I was not, because the dollar was going up and because I recognized the importance of the chart, I was a little more hesitant than I would have liked to have been this last week, but it's an important macro chart. And, I think we're going to take a couple week break here. I do. Right.
I do too. And I think you're going to see some development of some really good patterns on gold, silver, and the commodity side of the equation with that as well. My expectation, Mark, is we start to see 107 play as a resistance. Maybe that's a little bit of hope.
Breaks. Yeah, and maybe it breaks down the road, at which point it becomes incredibly important again, right? But for the short term, I mean, I just think we're going to hold here for the next couple weeks.
I do too. And that's a big call out because that's a big momentum.
Yeah, I think we do. And then I think that bottoms gold because the correlation in gold and the dollar, it was ignored for most of 2024. The second the election happened, there was an algo programs, right? That kicked in immediately. And all of a sudden the correlation in gold and the dollar was like back, right? And so if that correlation program's still running, if you top out on the dollar here, you likely bottom out on the gold in the short term here. Could provide some nice cash flow opportunities.
I do like the slowing momentum as we ended the week on gold.
I did, because it started to fight, right? You started to fight.
Well, dollar's still punching up, right? And gold starting that U shape, right? It's starting that slow U shape, which you like to see in terms of a support build. And it's happening right here at the 2550 level, which is pretty good as well.
Yeah, and so we'll monitor that. And obviously there was chaos in other areas, silver, copper, won't look at the charts. Let's finish off on Bitcoin though, Matt. Bitcoin, like one of those winners, right? A classic situation of something that is a clear thematic winner, right? A clear beneficiary of Trump administration policies. You're in overbought territory on multiple time frames, Matt. It's just one of those. How do you approach this type of rule standpoint? Everyone's going to have a different answer to that, right? Some are, your classic holders are just going to be like, great. Just from a quick trading standpoint, then we're going to wrap up. Interested in high bases here, breakout, even in overbought conditions. Like, how do you handle those situations?
Yeah, I think you are interested in any secondary development here. Absolutely. The only question is, are you going to get something clean or are you going to have to chase something dirty? And right now it looks like you're going to have to chase something dirty, quite frankly, because it's quite a bit of volatility at the top there. You still see it as a very aggressive side of the equation, meaning day traders are partying here, but investors are starting to park money. And I think that's more than anything, I think that's what we're seeing. I think we're seeing investors come in little by little by little by little, starting to build positions, starting to put a little cash to work. I think that's what you're seeing play out far more than any active trading going on. I just think you're getting millions of people coming in with small sums of money saying, I'm willing to party a little bit. Obviously, you're always going to have a little bit of big players here too, but I don't see a clean secondary setup on Bitcoin as of right this very second. You look at iBid, it's starting to develop a little bit, acting with $50 out as a support, but you're still fairly elevated against that 9 EMA. And typically in momentum environments, I typically recommend on the technical side of the equation not to chase too far above the 9 EMA after a parabolic run. That goes to the greater fool theory, which means you got to find a greater fool than you to pay you a higher price than you're willing to pay some other fool out there. It's better to wait on opportunity. It's better to wait on a pullback. It's better to wait on consolidation, allowing that 9 EMA, because as of right now, you really can only see it from a bar by bar perspective, which is perfectly fine, but that's the only way you really can see that as well. One quick word, I know we need to get out of here, but one quick word on Ethereum. Ethereum, Mark, I actually have more interest.
That's a nice pullback.
Yeah, I actually have more interest in Ethereum than I do Bitcoin right now because of the overall technical conversation here. You're chasing Bitcoin. You actually got a pretty constructive pullback here on Ethereum, and now you're testing that 9 EMA. I think you could really structure a good trade here on Ethereum, where I think on Bitcoin right now, you just have to chase. And as a trader, I'm going to take the look on Ethereum a little bit more than the look on Bitcoin right now.
Well, listen, technicals, the separation, this aftermath, right? The aftermath will continue this week, right? You're going to see pullbacks separate from one another. You're going to see, those things that are sticking further develop. My final word is sign up for that free trial. All right. Have a great week, everyone.